When I say that you're one of the OGs of the space, that's a reference to, the OG rap community in California, your backyard, of course, right? It's the greatest and the most visionary part of the history of that music genre, I think, in my humble opinion.
Thank you.
This is ClimateTech with Kentaro, a podcast featuring the brightest minds and most influential voices in climate tech. I'm your host, Kentaro Kawamori. Imagine being one of those people who can see a category winner in a new market before the rest of the investing cohort does. Well, today's guest, Dan Ahn, is one of those I see what others don't type of VCs. Dan has the true street cred in identifying dominant companies early, before markets take hold. Dan is the co-founder and managing partner of Clearvision Ventures, a leading evergreen venture capital fund which he co-founded to help world-changing entrepreneurs. During his over 20-year venture career, he's had the privilege of working with entrepreneurs, sometimes as the founding VC. Prior to Clearvision, he was a managing director at Voyager Capital. There, he led the firm's Silicon Valley investment activities, which included investments in AutoGrid, ChargePoint, ClearCare, and Wise.io, all in their very first venture round. In this episode, we talked to Dan about what it was like to have a front row seat during the first clean tech bubble. Dan also shares what he looks for in founders and what he saw in the future of electric vehicles, or EVs, that most investors on Sandhill Road failed to see at the time. When Dan founded Clearvision Ventures in 2015, he had about 17 years of VC experience behind him already at that point.
I always thought it was ironic how VCs are always looking at and investing in innovation disruption, but their own business model themselves really has not been innovated or changed in probably 40 or 50 years. So a few things about what we wanted to do was, first is we're structured as a long-term evergreen fund. And so that means a couple things, but primarily means the fund has no end of fund life explicitly. So we can hold investments for an indefinitely long period of time. Because I think some of the things that we're trying to accomplish, or rather help our companies accomplish, will take a long time. That's just the nature of it. Today, people think in much shorter time frames and cycles, but traditionally, venture, having been in it for over 20 years, it can take a long time to build great companies. The second thing we do is we're not especially opportunistic. We tend to map out and really understand a space, particularly at the intersection of software and sustainability and sustainable infrastructure. That is our focus. And really try and figure out what company is going to be the category leader in a category that is going to be meaningful as well. Those two things. So we are very selective. I think we've become known for that, being the category leader partners, I guess, if you will. And so the final thing is, through our LPs, we like to bring additional networks for potential customers and partners to the table. So those are the three premises that we put together the firm. And of course, I'm really pleased that my partners and colleagues, we're all veterans. We all have been in venture for 20 plus years. And we've all been entrepreneurs as well before entering the venture capital industry. And so we really know what it's like to be in the entrepreneur's shoes in good and bad times. So that's a little bit about, our firm.
Coming back to some of our first conversations, that was always, some of the biggest, I think, attributes that make Clearvision so special, right? Is the combination of the track record that you all have as investors, which, you're now coming up on 25 years soon of VC investing, which is an eternity compared to a lot of the newer class of VCs over the last few years. And, coupled that with the business model innovation, like you talked about, like evergreen funds, so much more founder aligned and incentive based over the longer term. But then, like you said, also having the operating experience, that's a pretty rare sort of triumvirate combo from my experience. But also your focus on the category leading sort of thesis, right? Maybe let's jump right into that. We talked a little bit about some of your super early investments in hindsight into some of the EV infrastructure, which I know was a little bit outside of the core today, which is primarily software based, but some of your investments into, say, AutoGrid or ChargePoint specifically, where You guys had a strong thesis on the EV space. You're seeing Tesla come up. How did that come about? So you're there early, you see it come to fruition. What went down?
Right. So that actually began in terms of our thinking earlier in the cleantech 1.0, I guess, bubble in the early 2000s, which of course didn't end very well. And many VCs invested in many things that were very, very capital intensive and really were not appropriate for venture, I guess. There are some high profile failures that we all know about and some lower profile ones too. And so, I always believe that, information technology, software really had a role to play when you apply it to sustainability and sustainable infrastructure. So I got interested in that probably around the 2007 to 9 period. So it's going back a while. So really applying technology to this area is not a new thing for me or for us. And so you mentioned one of the companies that I had the privilege of leading the first round of was ChargePoint. That was back in 2009. It was not called ChargePoint then. It was called Coulomb Technologies. But they changed the name because nobody knew what a Coulomb was, which is interesting.
That's a way better name because I don't even know what a Coulomb is.
It's a unit of electrical measure, right? So most people don't remember that part of physics. So they changed that. And what's really interesting was a few things about it. The founder, the original founder, Richard Lowenthal, was a true visionary. It wasn't his first startup company. He'd actually gone into politics for a while, decided he didn't like politics, and came out and decided to start one more company. And the whole idea of the company was networked energy. Most people don't know that. So they wanted to apply networking software expertise to energy, electricity. And so they said, why don't we apply that to both the grid and EV charging? And so they were really the first company that attached a networking capability to an EV charger. And they actually have a granted patent on that. So most people don't know that connecting an EV charger to a data network of any kind, wireless or wireline, is patented by the company. And so the other companies that are doing that are violating their patents. So that's just a little factoid. And the original team were really networking software people out of Cisco, Riverstone, Stratacom, those folks, which I was really familiar with early in my investing career, having looked at many companies in that space. So I thought that was fascinating. So back then, there was no Model S. I think Tesla had their first Roadster, and there was the Mini Cooper E that Richard used to drive around in. It was a really fun car to drive. But most people, even on Sandhill Road, didn't think that EVs are real. They would talk about the past and the EV1 launch. That was a failure.
In just a moment, Dan will share how he saw the possibilities and opportunities within the EV space.
If you look at sort of the cost curves of batteries even back then, you quickly saw a point where it really did make sense. It was cost effective to drive an EV around. And it's, of course, continue to come down the cost curve. That's pretty well defined in batteries. It's not exactly like Moore's law, but it's similar. So if you look ahead and believe that the cost curve makes sense, then EVs make sense. And then the next thought was, well, wait a minute. In a world where people want to drive EVs, because frankly, the experience is just so much better. Like I haven't been to a gas station in years, literally. Then you need all kinds of other things. You need a charging infrastructure, particularly in a world where not everyone can charge at home in their garage, because they may not have a garage. But if you believe that, then you need a network. You need the data. You need to control that network. You need to track charging, this and that. You also need to track the usage, because eventually there'll be usage tax on it, because, hey, guess what? What pays for our roads is the gasoline use tax. But if gasoline goes away, you're still using the roads. How do you pay for those roads? You probably need to tax the electricity that goes in the cars too. Eventually that will probably happen. They actually patented that as well years ago. So they're truly visionary in that. So most people don't understand that. And all the other people came a few years after, a lot of the done okay, are really sort of essentially copycats on that. So there are other things I can go into, but I thought someday the cost curves will make sense. This will be real. The experience is better. And in that world where people are driving plug-in cars, you need this. You need this infrastructure. You need this company. You need the networking capability. And I just believe that in the case at that time, in this case. Yeah, so those are the main thought process that went into the original ChargePoint investment. Again, once called Coulomb Technologies originally. So I invested when the company just had a few $100,000 in revenue and had raised, the money they raised was really from the founder himself. And so I led the very first venture round. And so it's been a terrific journey since.
Dan says that what really catalyzed the EV market was the launch of the Tesla Model S.
That was the really first high-end, obviously, but sort of mainstream high-end production car that everyone liked and adopted because they just liked the car. It's just really nice to drive. I don't know if you remember the first time you got into a Tesla or an EV and tried it. I thought, oh, wow, this is great. It's way better than driving a gasoline car. Just the experience is just so much better. I knew that was a future. And I remember after I funded ChargePoint, my kids were very young then. And I remember telling my family that someday either our kids or grandkids will think it's crazy that people used to pour flammable liquid into a vehicle, combust it and burn it just to get around. And when you describe an ICE that way, when you think about it, it's kind of crazy. You're pouring flammable liquid into a chamber and combusting it and burning it just to get around instead of just charging a battery and getting around. And so someday, I know young folks will think that's just crazy, combusting flammable liquid to get around. And that was, I remember a conversation I had with my family many years ago, like over a decade ago. So it seems to be finally coming true.
No doubt about it. And that's the cool part of the Tesla history, right? Is when Elon went out to build the Model S, he just wanted to build the best car, right? Distinctly, he always talks about that. It was about building the best car, and it just happens to be an EV, and that's how you get the market to mainstream adopt it. But super cool to hear kind of the origin story from the venture side on ChargePoint. And then, of course, was it last year? Was it a couple of years ago? A company went public. It was through a SPAC, I think.
Yes, they went public last year. That's right. They finalized it last year.
That's exciting. I've definitely seen them pop up everywhere. I was taking my daughter to the zoo here in Phoenix 3 weeks ago or so, and they were constructing a whole new charging station in the parking lot in partnership with our local utility, and saw the ChargePoint logo all over that, which was pretty cool.
Nice.
In March this year, Australian-based renewable energy company Sun Cable raised over $150 million in its Series B funding round. It's super interesting. It immediately, when you said sort of thinking about it from a networking perspective, they're building what they say are the systems and infrastructure to essentially create an intercontinental transmission of renewable electricity. And so taking a different approach to the storage problem, so to speak, and the distribution problem. But I was like, wow, they're basically describing a renewable energy network. So that immediately reminded me of that.
Well, I think it was that network that really helped us cement their category leadership. And in North America, they still continue to have a 70+% market share. And there are good reasons why. And
wow, I didn't realize it was that large.
It is, yeah. And it'll be very hard to encroach upon that for years to come. And that was, of course, part of the original thesis for investing in that company and similar analogies in most all the companies that we invested.
So in terms of the flywheel effect, they must be extremely well positioned then to continue that level of sort of market share into the future.
They have. And I think, one of the sources of sustainable competitive advantage that I had helped to define with the company, and one of the things that we sort of like to talk about is the playbook for game over. Like, what does it take to really cement your market leadership position? And so when early on, they wanted to address many different segments of EV charging, residential, this and that, and it was a much smaller company with limited resources. And so we basically defined that the core target market they should go after is the intersection of one, the ability and willingness to pay money, and the value and importance of having a data network. And that is squarely enterprise workplace charging, the parking lots you see all over in companies, particularly here in Silicon Valley, but in other places too, because they're not that cost sensitive and they really want a data network to, don't forget that was unusual then, right? They really want a data network to track the level of charging, slow charging at peak times, figure out when the utilization is high and they need to order more chargers. And that was really important in creating really strong local network effects, because once their network got into a workplace like Google or Apple or Cisco, some of the early adopters, it's not going to come out, and they just keep repeat purchasing when they reach a certain level of utilization from the company. So actually back then, at least as recently as just 2 or 3 years ago, it could still be the case. The majority of their revenues actually just come from repeat systematic programmatic purchases from existing customers. And that's a really hard thing to encroach upon. And that segment of the workplace charging, what they call level 2 charging, is probably the most profitable segment. It's the only profitable segment of EV charging right now, actually. So when you have that dominant market share in that, it's very hard for another company to attack their leadership position. So what you're seeing is kind of niche plays, right? Now, back in the day when they were establishing their network and growing it, there were a couple other ones that had grants and they were trying to give away free chargers. And the customers like Google would say, we don't care about free. We want something that works a certain way. So anyway, I think those were some of the factors early on that really led to their market category leadership.
Interesting. Yeah. Free is a devilishly complex thing to make work well. There's a lot of questions around value when you throw that word around.
Exactly.
The ChargePoint deal and you being first, institutional check into that is such a great example of your, looking for category leaders or category creators, right? And, when I say that you're one of the OGs of the space, that's a reference to, the OG rap community, like in California, your backyard, of course, right? It's the greatest and sort of the most visionary part of the history of that music genre, I think, in my opinion, my humble opinion. I'm not a rap expert, of course, but really takes a certain type of approach and character, right? To be first in and to create something and then identify that. And, in today's venture world, we have record amounts of dry powder. You've got crossover investors that just peanut butter and create index strategies across venture, and they just plug metrics into a model. That makes it extremely unlikely that those venture investors will find category leaders as a first check, at least, right? And so their returns are going to be significantly deprecated coming in later rounds.
That's right.
Which for them is fine. That's their model, right? But you don't find 100x return profiles in that approach. So when you look for category leaders, right, sometimes even before product market fit, right, or approaching product market fit, how do you think about the various pieces of signal that you need from your perspective, and how do you go about identifying those businesses and those teams along the way? What do you think are the most important components of doing that?
Well, I think there are a couple of sides to it. One is the team is really important, meaning can they scale and grow? And it doesn't have to be in the role that they originally have, but can they scale and grow to an organization that can be a leading company, eventually be a standalone public company or not? And I've recruited dozens of senior executives in the companies as well as independent directors. So I have a good sense of, can a person really scale? What are the things that they need to do two things? Obviously, recruit the best people on the team and make them successful. That is basically just leadership 101. So that's one thing that obviously I look for. On the company and the market side, we really look for a broad range of sustainable competitive advantage. That's a very sort of often used and old academic kind of term, but we really do think about that very deeply. Why is it that this company is going to maintain its market position when other competitors are going to come after them, potentially with larger budgets and dollars, even some of the mature companies? And what's going to sustain that competitive advantage over a long period of time, even a decade or 2 decades, if you look at some of the great companies. And so in those markets where you have a possibly winner take most all, a team ready and able to scale, and well-defined sustainable competitive advantage, that's where the dominant category leaders come from. And then you just hope that the category itself becomes a good category. Sometimes they take longer to develop. Certainly the EV trend took longer to develop than we thought. Now everyone thinks it's inevitable, but that was not the case 5 and 10 years ago. If you look way back in the last 50 years of great companies, the vast majority of the market value creation was taken by the category leader. When you think about microprocessors and Intel, let's go way back, right? Not the really obvious recent examples like social networking, Facebook versus MySpace, or Google in search, or, versus the 12 search engines that were venture funded or around when I first got to Silicon Valley in the late 90s. There were lots of them, by the way. And so it's not as if the number 2 and 3s can't do pretty well, but the number 1 company really earns a dominant share of the market value creation. And what's interesting is that really even early stage and late stage investors don't really seem to understand that. So if you look at every great company's rounds, when they did those rounds, particularly as they got more mature, they all seem really expensive at the time.
In 2010, Facebook reached 500 million active users. The following year, Goldman Sachs and Digital Sky Technologies invested $500 million in Facebook, which propelled the company's valuation to $50 billion. That's a lot of fives and zeros.
I was like, wow, that was expensive at the time for where they were, right? But other companies that were able to establish terrific business network effects and sustainable competitive advantage include companies like Cisco, right? They were able to really establish and lock down their value-added reseller network, which is why at the time, companies like Bay Networks were bigger. They weren't number one at that time, but they emerged as number one over time for specific reasons. And so we really look for what those reasons are, and they're a little bit different in each case. But there are many examples on the history if you really look at it. So
I think that's a great example, like a more recent one. I know several VCs that invested into Stripe at the Series D phase. And I remember the market, this was in 2016, and they were raising it was just under a $10 billion valuation, and people were going, you're insane. Like, you're in the middle of the record amount of appreciation on price. And those VCs went, yeah, no, I think this is a $100 billion company. And, even at a $10 billion price, there's 10x upside here. And lo and behold, 2021, company's valued at just under 100 billion. And surely they're going to be multiples of that even in the future. So yeah, it's a great example. And also, I think a trend that I'm seeing, right, and I think a big differentiator between the successful VCs and the not so successful VCs is the not so successful ones have to learn that if you focus too much on all the things that could go wrong, you kind of miss the thread of all the things that could go phenomenally right.
that's right.
And man, I see this all the time, especially in the younger VCs, right? They spend all this time on sort of the downside analysis, and they don't spend enough time on the upside analysis. And that's kind of the game, right? Is like, study history and figure out, why did the winners create categories? Why did they go through? Not why did the losers lose? It's sort of a backwards way of looking at the venture landscape, I think.
That's right. And I think I'll have a couple of comments on that. One is, a lot of folks do come from a pure sort of finance and finance analytical background. And people like that, there's nothing wrong with that, but are really good at looking at the past, analyzing what's there, not really thinking about the future. So I have a story back in the late 90s. I talked to a VC. He's retired since then, but who had worked in VC both in Boston, where I went to school, and out here on the West Coast. And I asked him, what's the difference between VCs in Boston and the West Coast? He goes, very simple. The VCs in Boston think about the past. The VCs on the West Coast think about the future. So I thought that was a really interesting way of putting it. Now, that was back in 98 or 97. 97, I think I asked that person then. And so that's a long time ago. The industry has grown since then. And with a lot of new folks that have come in that are really focused on things like, just price, right? They're really driven by price. There are some firms like that in this space. If it's not this multiple, they won't do it, rather than thinking, no, this is going to outperform and really be a winner in a category that's really, really meaningful and makes sense. Those two things are really important. And if you think about fund structures too, because many of the firm's investors are really new and unproven, it's become much more of an asset management game, right? It used to be that you had to really prove yourself with a track record of returns for 10 to 15 years before you went and fundraised on LPs. We certainly went through that, my partners and I, but that seems to be absent today. So it's really just a game of raising more money while you can, and hoping things work out. So, and maybe they will.
No doubt. Yeah. And I think, recent moves by, Sequoia, for example, becoming a registered investment advisor and being able to hold into the public markets, the math is pretty clear. It's kind of on two fronts, right? The 10-year fund cycle limits flexibility and decision-making on the private capital markets, but then also on the back end of it. Of course, not every firm can do that, right? It's expensive to become a public market asset manager investor as well. But if you're the size of Sequoia, it makes a ton of sense, because at that point you're leaving a ton of money on the table, not being able to hold into the public markets.
That's right. And I don't think it's just because of their size. There are other firms that have lots of assets under management that couldn't do that. It's really their track record and reputation that their investors just want to invest with them no matter what. And they're just about the only sort of really large scale, well-known firm that could do that.
Yep, no doubt about it. So you're, I would say, one of the few, very few, climate thematic investors that's been focusing on the software space, primarily for some time. I think, a bunch of folks are getting there now because everybody wants software-based return profiles. But, what are you tracking? Persefoni not included. That we can't cheat. That would be the easy answer. But in sort of the emerging climate or clean tech software space, what are some trends that you're tracking that you think are interesting and could come to fruition here over the next few years that don't exist today necessarily?
Well, very recently we've been looking at, it is related to Persefoni, but really looking at carbon markets, and as a carbon market, how that will pan out in terms of what you do in terms of offsets, various marketplaces, looking at how the folks that own sort of nature-based infrastructure, how they can sort of monetize that and get to market. So the whole marketplace of carbon is something that we're looking at. And there are a few characteristics to it that really tie well with our investments and our investing themes throughout the history of our firm anyway. Is one, there are very clear ways in which software can add value to it, whether it's the application of AI to physical assets or something as simple as trees. And there's a lot of data. So we really like companies that can use software to be a system of record, or really collect, analyze, and have data that's just really important and valuable in climate. And so the carbon markets are one. Years ago, we had gotten to sort of weather and weather data. That's another area where data is really important. It impacts many different things, and it's always changing, right? And so we like that. We like companies and thematics where there's software, there's data that's always changing, and that's also really valuable and just broadly applicable.
Great. Very last question. In the broader climate tech community, who do you want to hear from? Who should reach out? How should founders get in touch? Are you still actively deploying capital? All that good stuff. Let's put the Clearvision PSA out there.
Sure. So absolutely. We continue to remain active. And we will for a long time. We have dry powder to deploy. We also can, I think I might have mentioned, we can recycle capital when companies exit too, and we do, and redeploy it for a long period of time. Generally just find someone that knows us in this space. That's the most important thing. But we're also looking for you too. We do find and reach out to companies that we think are potential category leaders in really interesting categories that we are researching. So we do that too. Well, we thank you a bunch for coming on the podcast, and it's been enlightening and fun to learn a bit more about some of the early days, especially. And as always, it's great to see you, and thanks again. Likewise. Thank you for having me. I hope you enjoyed my conversation with Dan as much as I did. And if you want to learn more about what they're up to at Clearvision Ventures, or if you want to reach out to their team, just head on over to clearvisionventures.com. Before we go, please don't forget to subscribe to ClimateTech with Kentaro on Apple Podcasts or whatever platform you listen on. In case you haven't heard, we also launched ClimateTech Deal Digest, where I highlight M&A and funding news in the climate tech space. We drop new episodes every Tuesday. Thank you all for listening, and I'll catch you on our next episode. ClimateTech with Kentaro is produced by our incredible team at Persefoni and Hueman Group Media. Our theme music is by Guest House. And if you want to learn more about Persefoni and our climate management and accounting platform, please visit our website at persefoni.com.